We're going to talk about some financing ratios here. A lot of this is just looking about at the amount of debt you have, and is that a reasonable amount of debt is what you're looking at. One of the first things, one of the most obvious ones of these is the debt to equity ratio. So you're just taking total debt divided by total equity. I've got this thing here. Remember we've got debt plus equity equals total assets. So it's just kind of taking a percentage here of, it's not exactly a percentage here, but it's just a representation of, 100% of your assets are funded with debt and equity. And so what proportion comes from debt, what proportion comes from equity? It's one ratio to look at in evaluating the financial stability of a company, its ability to pay its debt. Best served with an example, I guess. Here we're going to look at calculating the debt to equity ratio of Lowe's and Home Depot. So I can just calculate that here. Remember, again, these are balance sheet items. So I'm going to take averages. And for this debt to equity ratio, we're just going to take the total liabilities. So I'm going to take the total liabilities. I'm going to take the average of 17 and 18, 2017, 2018. And I'm going to divide that by the average amount of equity for those same years. So here's total shareholders' equity. And do that, and I'll get that number there for Home Depot. Now, I'll point out here that this is a very strange number for Home Depot. You get a negative debt to equity ratio. It is a little bit interesting here in that if you look at shareholders' equity for Home Depot, what you find is that their shareholders' equity actually goes negative in 2018. And what that represents is stock buybacks that the company is doing. You can see here that in their shareholders' equity account, there's a subtraction here for less treasury stock, and that amount is going up, right? And they're doing an enormous amount of buying back their own stock, right? Now, this doesn't mean that they bought back all their shares and an additional, amount to make this go negative. It just means that they bought them back at a much higher price than they were originally issued. Right, so when that stock was issued, let's say just for example at $1 per share, then it goes on the equity account here in common stock at the common stock and capital surplus at the amount you sold it for. All right, that's what it shows up on the equity section of the balance sheet. That's what it's recorded at. And if you go back and buy it later at a much higher price, say $20 per share, it's increased 20 times. Well, then the amount you spent to buy it back goes in here as the treasury stock amount. You buy it back and you put it in treasury stock. And so that's just saying that they've spent a lot more money to go back and repurchase stock than they got from issuing the stock in the first place. All right, and that's why that has gone negative. And it's very difficult to make a value judgment here as to whether that's good or bad. There's a lot of things there. It's one way to return cash to shareholders, right? Is to buy back your stock, and you have to really study the actual details of what's going on with the company to be able to make an opinion there as to whether you think that's good or bad. But anyway, notice the calculation here. We're just taking the average amount of total liabilities divided by the average amount of total equity, and I can do the same thing for Lowe's and calculate their debt to equity ratio. And you can see that is 6.33. Right? Just saying they have a lot more debt than they do equity. Again, I believe if we look at Lowe's shareholders' equity, and actually, I'm wrong about that. They do not have any in this treasury stock account, so they are not making a lot of buybacks there. So that's just saying that they're financed with, for every dollar of equity, they have $6 of debt. Is that good or bad? Well, that's a pretty significant amount of debt, but we're going to look at these other ratios here that will help us make more of a judgment as to how well the company's using debt. Okay? So in fact, go back here and we'll just talk about those. So when we're looking at, well, is the company using too much debt, the right amount of debt, are they in trouble with debt, that kind of thing, there's some ratios we can look at to make a judgment there. One of them is times interest earned, and it's EBIT divided by interest. So the earnings before interest and taxes divided by the interest expense. So it's just saying, okay, of the amount of money that you're generating from your business, okay, after you've paid all of your expenses, do you have enough cash around to pay the interest? And EBIT over interest is one way to get that, and it's times interest earned. Okay, and obviously you need this to be, or you would like it to be at least one, right? Meaning now you've got enough around to make the interest payment. And that the higher the number is here, the more easy, the easier it is for you to pay your interest expense that's due. Right? When it gets to be less than one, you can start having problems here, that you have an awful lot of debt and you're not generating enough profits from the business to pay the interest expense on that, which companies can handle for short periods of time, but you cannot continue that for a long period of time. So that would indicate the closer you are to one or less than one here, the more troubles you can have from your debt. All right, if we calculate this for Home Depot and Lowe's, I'll mention here that in the financial reports I have, EBIT is called operating income after depreciation. So we'll see that in the spreadsheet here. So if I go down here and I calculate operating income before depreciation, I'm going to divide that by the interest expense. Now remember, these are income statement accounts, so I don't have to take any averages here. And I want 2018, which is column F. And I'm going to take here operating income after depreciation, and I'm going to divide that by the amount of interest expense that I have. So that's it right there. And for Home Depot, that's 15, which is a very good number there. That's for 2018 at least, they're generating plenty of profits from the business to be able to cover their interest expense. Right? And Lowe's, I can do the same calculation here. And for Lowe's, it's 7, just over 7. So for both of these companies, at least for 2018, they don't appear to have any problems with being able to service their debt. They're making plenty of profits from their business to be able to pay their interest expense. Again, if you had to make a value judgment here, the advantage would go to Home Depot. All right, they're much, they're making 15 times their interest expense in profits, whereas Lowe's is only making 7. But in both cases, neither one of them seems to be in any trouble being able to meet their obligations to pay their interest expense. Right? Okay, and now there's another one that we look at here called the cash coverage ratio. And what we do is we take EBIT and we add back depreciation and amortization. The reason we do that is because these depreciation and amortization are accounting charges. They're not cash expenses. And so because those don't come out as a cash expense, then that's money that the company really does have available to pay its interest. So we will often add those on there as a more cash defined measure of exactly how well these companies are able to meet their interest expense. So I'm just going to do that here for Home Depot and Lowe's. We can take the cash coverage ratio. So again, I can just go down here. I'm going to get the EBIT, which is operating income before depreciation, and I'm going to add back, operating income after depreciation. I'm going to add back the depreciation expense. Now, I hope you can see that it's obviously just this operating income before depreciation, right? Because I took this minus that, and that got me operating income after depreciation. So this EBIT plus depreciation is this value right here, operating income before depreciation. And then I'm going to divide that by the amount of interest expense that the company has. Right, and you'll see that that's even higher, and it would be higher for the company because you're adding back that depreciation. So for Home Depot, it's 17. If we do the same calculation for Lowe's, that becomes 9.5. Okay, again, advantage to Home Depot, but neither company looks like they have a problem here in meeting their interest expense. Okay, so that's financing ratios. We'll talk about activity ratios in the next video.